A $9.3 billion order unwinds. Cisco just secured $9.3 billion in AI infrastructure orders, and Wall Street rewarded them by dumping the stock. Despite reporting a record $17.3 billion in fourth-quarter revenue yesterday, shares plunged nearly 8%. A sell-off this severe means something is broken in the P&L, and the culprit is the AI hardware itself. The hardware cost squeeze. The market isn't punishing Cisco for missing demand. It is punishing them for the cost of fulfilling it. Cisco built its modern empire on a high-margin blend of proprietary networking gear and sticky software subscriptions. But AI infrastructure orders from hyperscalers are heavily skewed toward lower-margin hardware. As these massive AI orders hit the balance sheet, they drag down overall profitability. Non-GAAP gross margins just contracted over 200 basis points to 66.3%, and next quarter's guidance pushes them even lower. Bulls argue that taking lower-margin hardware revenue now is a necessary loss leader to win market share and sell higher-margin software later. But right now, the physical material costs of this equipment are eroding their profit engine. Every new hyperscaler contract inflates the top line while compressing the gross margin. And that hardware shift reveals a permanent imbalance in market leverage. The signal under the noise. The massive order volumes and hardware cost squeeze we just saw are actually masking a fundamental margin transfer from legacy tech suppliers to cloud hyperscalers. Think of it like being a specialized contractor, where your only 4 clients have so much market power they can unilaterally cap your profit margin. The margin compression in Cisco's earnings isn't a temporary supply chain glitch. It is the permanent reality of selling into an oligopoly. When your primary growth relies on a handful of mega-cap cloud providers building massive data centers, they dictate the pricing power. You get the volume, but they squeeze the margin. For investors and industry strategists, the takeaway is brutal. A revenue beat built disproportionately on hardware is a structural downgrade to the business model, and you can no longer value these suppliers on traditional top-line multiples. Watch Cisco's first quarter 2027 gross margin actuals. If they slip below the guided 65%, the structural floor of the legacy enterprise margin model has officially broken. Subscribe for more.